Hello and welcome. If you're considering a personal loan, this video is for you. Personal loans can be a fantastic financial tool. They can help consolidate debt, cover emergencies, or fund major purchases. But before you apply, it's crucial to be aware of common personal loan mistakes that many people make. These mistakes can lead to loan rejection, higher costs, or long-term financial headaches. In this video, we'll go over key loan application tips and personal loan advice to help you avoid pitfalls and set yourself up for success. Personal loans are incredibly popular. In fact, as of 2023, over 22 million Americans have unsecured personal loans. With so many people borrowing, lenders are actively marketing loans, which makes it easy to slip up if you're not informed. By the end of this 30-minute guide, you'll know the common personal loan mistakes to avoid before you apply. We'll cover everything from checking your credit to comparing lenders, from avoiding loan rejection to reading the fine print. So grab a notepad and let's dive in. Avoiding these mistakes will not only improve your chances of approval, but also ensure you get the best terms possible. Let's start with a mistake that might sound basic, but is all too common. Taking out a loan when you don't actually need one. It might sound surprising, but one common mistake is borrowing money when you don't really need to. Lenders often entice you with pre-approved offers via email or even text, advertising limited-time low rates or no fees. It can be tempting to take a personal loan just because it's easy or offered to you. For example, to splurge on a vacation or invest in something speculative. However, taking on debt without a specific need is risky. Remember, a loan is not free money. You'll pay interest on every dollar you borrow. If you borrow unnecessarily, you end up paying a lot of money in interest for something that wasn't essential. Think of it this way. If you accept a $10,000 loan just because it was offered, that could mean hundreds or thousands of dollars in interest over the life of the loan, draining your finances for no good reason. You might also be tempted to invest borrowed money in the stock market or another high-risk venture, hoping to earn more than the loan costs. This is generally not a good idea. It's safer to invest your own money rather than money you have to pay back with interest. How to avoid this mistake? Only apply for a personal loan when you have a clear, necessary purpose for it. For example, consolidating high-interest debt, covering an emergency medical bill, or making a vital purchase. Don't let flashy offers pressure you into debt. If you don't genuinely need the funds, it's usually best to skip the loan. Your future self and your bank account will thank you. Before you even fill out a loan application, one of the biggest mistakes is not checking your credit. Your credit score and credit report play a huge role in whether you get approved for a personal loan and what interest rate you'll pay. Lenders use your credit information to decide if you qualify and to set your terms. If you haven't reviewed your own credit, you're flying blind. You might have errors or surprises on your report that could derail your application if left unaddressed. Why this matters. Suppose you apply for a loan without checking your credit, and there's a mistake on your credit report, maybe an old, paid-off account showing as unpaid. The lender will see that and could reject your application or offer a higher interest rate. By checking your credit report in advance, you can catch and fix errors and get a better sense of where you stand. It also alerts you if your score is lower than expected. If your credit score isn't in great shape, you might decide to hold off on applying and improve your score first. How to avoid this mistake? Check your credit score and report a couple of months before you plan to apply. In the US, you can get free credit reports from the major bureaus, annualcreditreport.com, and many services offer free credit scores. Look for any inaccuracies and dispute them if needed. Also, gauge your score range. Is it good, fair, or poor? Generally, a higher score, think 700 plus, will get you better rates, while a very low score could lead to a denial. If you find your credit needs work, take steps to improve it before applying. For example, you can pay all your bills on time. On-time payment history boosts your credit. If you have any past due accounts, bring them current. Reduce your credit card balances. Aim for a credit utilization ratio below about 30%. That means using less than 30% of your available credit. Paying down existing debt can potentially raise your score. Avoid new credit inquiries for now. Don't open new credit cards or loans in the months leading up to your personal loan application. New credit lines and inquiries can temporarily lower your score and signal risk to lenders. Keep older accounts open. Length of credit history matters, so don't close your oldest credit cards if they have no annual fee. Taking even a few months to polish your credit can make a big difference. For instance, if your score is just below a lender's cutoff for the best rate, improving it by a few points could save you a lot in interest. One source notes that if your score is below about 660, it may be wise to hold off on a personal loan until you've raised your credit score into a higher range. Another mistake people make is not ensuring they meet the lender's requirements before applying. Each lender, whether it's a bank, credit union, or online lender, has specific eligibility criteria for their personal loans. These criteria typically include things like minimum credit score, minimum income, employment history, and debt-to-income ratio. If you apply without meeting these requirements, you're likely setting yourself up for rejection. And a rejection hurts you in two ways. You don't get the loan, and the credit inquiry could ding your score slightly. Imagine spending time filling out multiple loan applications, only to get denied because your income was below the lender's minimum or your credit score didn't meet their cutoff. It's a frustrating waste of time and can temporarily knock points off your credit score with each hard inquiry. Multiple rejections also look bad on your credit report. Lenders might view back-to-back denials as a sign of financial trouble or credit-hungry behavior. How to avoid this mistake? Do a bit of homework on each lender before applying. Most lenders publish their basic requirements on their website or disclosure documents. Check for common criteria, such as minimum credit score. For example, a lender might require a FICO score of 660 or higher. If your score is below their minimum, consider a different lender or work on your score first. Minimum income. Lenders often want to see that you have sufficient income to repay the loan. They may state a minimum annual income or require proof of income, pay stubs, tax returns, etc. Debt to income, DTI ratio. This is the percentage of your monthly income that goes toward debt payments. Many banks consider a debt-to-income ratio of 35% or lower as good for loan approval. If your DTI is too high, you might need to pay off some debt or increase your income before applying. Employment history. Some lenders prefer borrowers who have been in their job for at least a certain number of months or years, showing stable employment. If you just started a new job, you might not meet this for some lenders. Other criteria. Lenders might have age limits, e.g., 18 plus or 21 plus, or only lend to U.S. citizens' permanent residents. Some have restrictions on loan purpose or require a valid bank account. By checking the eligibility criteria beforehand, you can target lenders where you're likely to qualify. This way, you avoid unnecessary loan rejections that can come from blindly applying everywhere. For instance, if lender A requires $50,000 income and you earn $40,000, applying there is likely a miss. Instead, find a lender whose requirements match your profile. You might have heard the saying, "Don't put all your eggs in one basket." That definitely applies to personal loans. Not shopping around for the best loan is a mistake that can cost you a lot of money. Many people assume all loans and lenders are similar, or they simply go to their usual bank and accept the first offer they get. In reality, interest rates and terms can vary widely from lender to lender, even for the exact same borrower profile. If you skip comparison shopping, you could end up paying hundreds or even thousands of dollars extra in interest over the life of the loan. Consider this. Lender A might offer you a 3-year loan at an 8% APR, while lender B offers a 5-year loan at 11% APR. and lender C offers a 4-year loan at a rate of 9% APR with no origination fee. Which is best? It depends on your needs, but you wouldn't know those options unless you looked around. Accepting the very first offer without comparing could mean you miss out on a much better deal. Personal loan annual percentage rates, APRs, which include interest and fees, can range from as low as around 6% for excellent credit to 30% or more for poor credit, varying by lender. Term lengths, fees, and customer service also differ. How to avoid this mistake? Compare multiple lenders before deciding on one. This doesn't mean you should submit full applications everywhere. We'll talk about avoiding too many applications in a moment. Instead, use smarter strategies to shop around. Use pre-qualification. Many lenders let you pre-qualify for a personal loan online with a soft credit inquiry. A soft inquiry won't hurt your credit score. You usually input some basic info, income, desired loan amount, etc., and the lender gives you an estimated rate or range if you were to apply. Pre-qualification gives you a snapshot of likely loan offers. It's not a guaranteed approval, but it's a very useful way to compare rates and terms without affecting your credit. Check loan comparison websites. There are online platforms, credit bureaus, financial websites, etc., that allow you to compare multiple lenders at once. For example, Experian offers a free comparison tool to see personal loan offers tailored to your credit profile. Websites like LendingTree, Bankrate, or NerdWallet also provide rate comparison tables. These can be great for seeing a range of options side by side. Consider different types of lenders. Don't just check big banks. Look at credit unions and reputable online lenders too. Sometimes your own bank or credit union might give you a loyalty discount or have lower fees. Credit unions, in particular, often have competitive personal loan rates for their members. Compare the total cost, not just the monthly payment. A common pitfall is to focus only on the monthly payment. We'll cover that in the next section. When shopping around, pay attention to the APR, any origination or application fees, the loan term, and whether the loan has a prepayment penalty or other charges. The best loan for you is usually the one with the lowest combination of interest rate and fees for the term you need. Take your time with this process. Even a difference of 1 to 2 percentage points in interest can make a big difference. For example, on a $10,000 loan over 3 years, the difference between 8% and 10% APR is several $100s in interest paid. It pays to shop around. In contrast to not shopping around, some borrowers go to the other extreme. They apply for multiple loans at the same time, thinking it will increase their chances of getting approved quickly. This shotgun approach is a mistake that can backfire badly. When you submit a full application for a personal loan, the lender will perform a hard inquiry on your credit report. Hard inquiries typically shave a few points off your credit score temporarily. If you apply for several loans in a short period, those multiple hard inquiries can significantly hurt your credit score. Plus, lenders seeing a bunch of recent loan applications might view you as credit hungry or desperate for money, which raises red flags about your financial stability. Let's say you apply to 5 different lenders in the same week. That's 5 hard credit pulls. Your credit score might drop, and each lender can see on your report that you're simultaneously applying elsewhere. From a lender's perspective, this could imply that other banks might have already rejected you, or that you're trying to take on multiple new debts at once. As a result, some lenders could be more inclined to deny your application or offer a higher rate because they perceive you as a higher risk. In fact, making multiple loan applications at the same time can itself be a reason for rejection. Many banks consider it a sign of financial distress. How to avoid this mistake? You should shop around, but do it in a measured way. Use the pre-qualification strategy, as discussed earlier, to narrow down your top 1 or 2 options before doing any official applications. Pre-qualification uses soft inquiries and won't harm your credit. Apply one at a time, or in a limited, planned way, Choose your top choice lender and apply there first. Wait for the response. If you get approved and you're happy with the terms, you're done. No need to apply elsewhere. If you get denied or the offer isn't good, you can then move on to your second choice. Maintain a time gap between applications. This way, you're not racking up multiple inquiries all at once. Some experts suggest waiting even a few weeks between loan applications if possible. Avoid credit shopping for too long. Most credit score models treat multiple inquiries for the same type of loan within a certain window, usually 14 to 45 days, as one inquiry, because they expect you might rate shop. This mostly applies to auto or mortgage loans, but some newer scoring models might apply it to personal loans. Still, don't push it. Try to do your rate shopping within a focused period rather than dragging it out for months. Be strategic and organized. If you're using an aggregator or online marketplace that sends your info to multiple lenders with a single form, be aware that you might still end up with multiple hard pulls. Read the fine print. It might be better to directly pre-qualify on individual lender sites where you can to control the process. The key is to balance getting enough information to make a good choice, shopping around, with not damaging your credit or spooking lenders. Too many applications. If you handle it right, you'll find a great loan and only incur one hard inquiry, or a very small number. When that loan approval comes through, you might be approved for more than the amount you requested, or you might be tempted to ask for a bit extra just in case. After all, if a lender is offering you, say, $20,000, but you only need $15,000, why not take the full $20K, right? Well, taking a larger loan than you actually need is a mistake that can cost you in multiple ways. Here's why overborrowing is dangerous. Higher interest costs. You pay interest on every dollar you borrow, from the day the loan funds. If you borrow more than necessary, you're paying interest on money you didn't truly need. Over the loan term, this can amount to a lot of extra interest. A personal loan isn't like a credit line where you only pay for what you use. You're on the hook for the whole amount plus interest. Higher fees. Many personal loans charge an origination fee, a one-time fee when the loan is issued, often a percentage of the loan. If your lender charges, say, 5% origination, borrowing $20,000 instead of $15,000 means an extra $250 in fees off the bat. Some lenders might have higher closing costs or insurance on bigger loans too. More debt equals more risk. Human nature says if you have extra money in your account from the loan, you'll likely spend it, perhaps on things that weren't essential. That means you've increased your overall debt burden without a real need, putting you in a tougher financial position. Also, a bigger loan often comes with bigger monthly payments, unless you take a much longer term, which means more interest anyway. A larger required payment can strain your budget. We'll talk about affordability next. For example, let's say you need $8,000 for home improvements. The lender approves you for up to $10,000. If you take the full $10,000, that extra $2,000 might go towards something discretionary, but you'll be repaying perhaps $2,200 or more with interest on that extra amount alone. Unless you have a plan for every dollar, it's probably better not to borrow the excess. How to avoid this mistake? Be thoughtful and precise about your loan amount. Calculate how much you truly need to accomplish your goal. Build in a small cushion if you must. Maybe you borrow $8,500 instead of exactly $8,000 just for a safety buffer, but don't wildly exceed what's necessary. Lenders may try to convince you to take more. Remember, they earn more interest that way, but you are not obligated to borrow the maximum offered. Tips to right-size your loan. Create a budget for your loan purpose. If it's a project, get detailed cost estimates. If it's debt consolidation, add up the exact amounts you need to pay off. This prevents borrowing extra just because it's available. Don't round up without reason. It might be tempting to round up your loan. I might as well take an even $10,000. But if that's more than you need, resist that urge. Remember, you can't just give it back without cost. Once the loan is disbursed, the only way to undo borrowing too much is to pay the loan back early. But that may incur an origination cost you can't recoup, and possibly a prepayment penalty depending on the loan. So it's better to borrow the right amount from the start. By borrowing conservatively, you'll keep your debt under control. The more you borrow, the more you have to repay. It sounds obvious, but in the moment of loan approval excitement, it's easy to rationalize taking a bigger loan. Stay focused on your actual need. Before you take on any new loan, you must ensure you can comfortably afford the monthly payments. A common mistake is not crunching the numbers on your budget or ignoring them, and ending up with a loan payment that strains your finances. While lenders do assess your ability to pay, they calculate your debt-to-income ratio and look at your credit obligations, they don't see your full financial picture. They don't know how much you spend on groceries, utilities, kids, gas, healthcare, etc. So you can't assume that just because a lender approved you, the payment is affordable for your life. Why this matters. If you commit to a payment that is too high, you could be one unexpected expense away from missing a payment. Falling behind on a personal loan can lead to late fees, credit score damage, and lots of stress. You don't want to be in a situation where you're choosing between paying your loan and paying for necessities. Here are a few scenarios to watch out for. Choosing a short loan term with high payments. A shorter loan term reduces total interest, good, but raises your monthly payment because you're paying the debt off faster. It might be tempting to take a 2-year loan for a lower rate, but if the monthly payment is, say, $500 and you can really only manage $300, that's a problem. One expert warns to be extremely cautious before choosing a loan with a rate 0.5% lower, but a monthly payment hundreds of dollars higher. The slightly lower rate isn't worth it if the payment doesn't fit your budget. Overestimating your ability to cut expenses. Some people take on a big payment thinking they'll simply tighten their belts. Be realistic. Will you consistently forego other expenses to make that loan payment? If you've never had a $500 a month loan before, it might be harder than you think to adjust. Not considering future changes. If your job or income isn't rock solid, or you expect new expenses, like a child or buying a house, be careful with locking in a high payment. How to avoid this mistake? Make a budget and calculate your debt-to-income (DTI) ratio before applying. Here's what to do. Determine your monthly take-home pay after taxes. List all your current monthly expenses and obligations, rent or mortgage, existing loan payments, credit card minimums, utilities, groceries, insurance, transportation, etc. Don't forget those annual or semi-annual expenses, like car insurance or property taxes, broken into monthly amounts. See how much room is left each month after necessities. From that remainder, how much can you realistically allocate to a new loan payment without hardship? Use an online loan calculator to play with numbers. Many free calculators let you input a loan amount, interest rate, and term to see the estimated monthly payment. For example, Experian recommends using a personal loan calculator to estimate payments and payoff dates as part of planning. If you know the loan amount you need, you can quickly figure out what the monthly payment might be at various interest rates and terms. Follow the 35% DTI rule of thumb. As mentioned earlier, lenders and financial advisors often say your total debt obligations should be no more than around 35% of your gross income for comfortable finances. If adding a new loan pushes you well above that, you might be biting off too much. Some lenders may still approve up to 50% DTI or so, but that doesn't mean you should go that high. For example, if your monthly gross income is $4,000, 35% is $1,400. If you already pay $1,000 on rent and $200 on a car loan, that's $1,200. A personal loan with $300 monthly would put you at $1,500, 37.5% debt-to-income ratio. Borderline. You'd need to evaluate if your other expenses allow that. You've been approved for a loan and are eager to get the funds. But hold on. The loan agreement, all that fine print in the document, is extremely important to understand. A big mistake is failing to read the fine print or misunderstanding the full cost of the loan. If you skim over the terms and conditions, you might miss fees or clauses that could cost you money or limit your options down the line. Common things hidden in the fine print or often overlooked. Origination fee. This is a fee for processing the loan, often deducted from the loan amount before you receive it or added to the balance. It can range from 1% to 8% of the loan amount, depending on the lender and your credit. For example, a 5% origination fee on a $10,000 loan means you pay $500 in fees. Either you only receive $9,500 but still owe $10,000, or you pay $500 upfront. Application fee. Some lenders charge a fee just to apply or as part of closing the loan, separate from origination. This is less common nowadays, but it exists. Late payment fee. If you pay past the due date, the fee can be steep, sometimes a flat $25 to $40 or a percentage of the payment. The fine print will say when a late fee is charged, immediately after the due date or after a grace period, and how much. Valerie Figueroa, a financial expert, notes that late charges can be very high on some types of loans, so you definitely want to know this up front. Prepayment penalty. Believe it or not, a few personal loans will charge you a fee if you pay the loan off early. This is a penalty for early repayment because the lender misses out on some interest. Not all loans have this. Many personal loans thankfully have no prepayment penalty, but you must check. If you think you might want to pay extra or pay it off before the term ends, a prepayment penalty could cost you. Other charges. Some contracts include things like check processing fees, fees for failed payments, e.g., if an auto debit bounces, or even insurance add-ons. Closing costs or credit insurance might be offered. If you opt in, that's an added cost. Beyond fees, the fine print covers all the rules of the loan. For example, it will state the interest rate, the APR, the payment schedule, what happens if you miss payments, how and when they report to credit bureaus, whether the rate is fixed or variable, etc. Understanding all terms and conditions before signing will help you avoid nasty surprises later. Applying for a personal loan can be a smooth process if you prepare well and avoid the pitfalls we've discussed. To recap, the key personal loan mistakes to avoid before you apply include taking a loan you don't need, neglecting your credit health, ignoring lender criteria, failing to comparison shop, borrowing too much, not budgeting for repayments, and skipping over the fine print. By steering clear of these blunders and following the tips we've outlined, you'll greatly improve your odds of a hassle-free approval and a positive borrowing experience. Thank you for watching and taking the time to educate yourself on loan application tips. We hope this discussion helps you avoid loan rejection and costly mistakes, setting you up for success with your personal loan. If you found this video helpful, please give it a thumbs up and consider subscribing for more financial tips. Good luck with your loan application, and remember, knowledge is power when it comes to your finances. Apply with confidence and borrow smart.